Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to discuss how to analyze IV term structure and go over a few important indicators that can help you backtest and scan for new strategies. Matt, do you want to share your screen and get us started?
Sure.
Thanks.
So let's clarify what we're talking about first. There are two types of skew that are most popular. There's a term structure skew, that is the at-the-money volatilities at expiration going out through time. And then there's a put and call strike skew in each expiration. Now, we refer to the strike skew as a slope. So we just take a slope of that line. So we'll look at GME here, GameStop. And this is the opposite of what most stocks have. GME has a highly, what we would call negative slope, because it's negative, it's opposite of what is usual. Usual is SPY, and 90% of the other stocks and ETFs is where the left side or the put. So these are all expirations. The low strikes are on the left and high strikes are on the right. And the low strikes generally have a higher volatility. Now, what that means and the reason that happens is because traders are expecting more volatility to the downside. So they expect more multiple standard deviation moves to the downside than what happened to the upside. So that does happen with SPY and normal stocks. However, there are a number of stocks that will get more volatile to the upside. Gold, like when there's trouble in the economy, gold will rally and it will get more volatile on the upside. Some of these meme stocks, when people start piling into them, they'll get more volatile on the upside. So you'll see these out of the money calls have a lot more volatility. So far so good on that, Tyler.
Yeah, so this monthly implied volatility chart that we're showing, you don't really see it that often. I like to think of it as a 2D representation of the volatility surface, right? You see that term volatility surface everywhere. This is kind of what it looks like if you flatten it out. It essentially has three axes, right? Where you have the X and Y axis, but then we also stack like 10 graphs right next to each other. It's just kind of an interesting way to view it.
Yeah, it's a good way to put that, Tyler. You could see pretty clearly each different expiration. So going out in time, but also going up and down in strikes. So yeah, we've tried to, you see these 3D like fancy charts, but you can't get anything out of it. It's very hard to see. But with this, you could see this gray line behind it. That's the term structure. So, there's been quite a bit of volatility in the market right now. Market's down 0.2% this morning, and volatility is high, or contango is when it's low in the front. Backwardation is the backward of the contango. So we're in backwardation right now in SPY, and so you could see that. So it is kind of like a 3D chart on a 2D, you're not seeing it come out at you as a 3D chart might. But so those are the two types of skews. So I just want to make that clear that there are the two types that we generally look at.
Right. So it's the contango versus backwardation, sort of looking at the week to week, and then there's the intra week put call skew that you're looking at.
Not intra week, but intra. The strikes by expiration by expiration, or term structure, full all expirations across that kind of history there.
Okay. Yeah, I was assuming one expiration per week, but in the case of SPY,
it's not always like that. Yeah, you just want to be you want to be clear on how you say this. And then ORATs, we break that down historically. And one of the reasons that I brought up this topic is people are asking me, how do you look at strike skew? Do you look at it? Some people look at the 25 delta versus the 75 delta call, and then that ratio. Some people look at, well, 10% of the money one way, 10% of the money the other. And ORATS uses delta on the axis, on the skew axis here. So right here, I know it's the bottom left, but here's a 50 delta, here's a 100 delta, call delta. So these are the low strikes. So those are the high volatility in SPY. We'll go back and look at GameStop and we'll see that's the opposite, but this is typical. So some people will divide the 25 by 75 delta. Some people will just look a percentage out of the money, and other people like us will look at the deltas, but we'll take a tangent. We'll take a slope at the tangent, and then also talk about the curvature there, because you can see it's not a straight line, it's curving as you go out. So we explain the IV skew in terms of a sloped line at the tangent of the 50 delta at the money, and then how much it curves off of that. Now, the importance of that is what we'll get into later. Then once this normalizes, meaning you're able to compare different months and different stocks when you do it this way. If you're doing a percentage, that doesn't really account for high volatility stocks versus low volatility stocks. High volatility stocks have a much higher probability of moving a certain percentage than a low probability stock. So delta brings that into account, because delta uses volatility for its calculation. So that's why it's important to use delta on the axis. And now, so we're down to 2 from the 3. We've kicked that percentage out of the money. 25 versus 75, I think, misses some information, because it doesn't account for the smile, or what we call the derivative of the slope. So there's a slope, but there's also the curvature. If you just measure 25 and 75, you're not going to get the amount of smile. It's just going to, it might even be flat, but like actually it might be, there might be a slope to it, but you'll miss it if you just use 25 and 75. So that's why we do it the way that we do it. Does that make, it's kind of it's a difficult concept, but there's a big reason. And I was a market maker back in the day, and this was an important distinction. In order to follow slope historically and be meaningful, you need to look at it that way, because a derivative will throw off your slope, and it'll throw off your historical representation of it.
Yeah, I never really thought of it like that, but now that you explain it, it makes a lot more sense. And yeah, one thing very unique about ORATS is all of our indicators that we kind of quantify the entire volatility surface. The volatility surface is a big thing, and to quantify it the way that we do, so that we can kind of make sense of what's happening, is really interesting. So what's this slope versus similar chart that you're looking at?
So we don't want to look at SPY in a vacuum. We want to look at if the slope of SPY, meaning how steep that is, right? So it goes down from like so we want to look at it versus its components. So we could look at SPY slope versus its components, and SPY is often much steeper than its components, meaning you might have an average slope of what we call like a 5% slope, and then in SPY, but only a 2% slope in, or 2.5% slope in its components. And so that's why it's usually about two times. But lately, it's been going way up. So it's almost 5 times. Now it's coming down, but it got very, very steep in SPY. As you know, it tends to happen when there's a lot of worry in the market, but there's not a lot of volatility. But you could tell they know the market knows there's something coming up. That's when you get steep slopes, and now it's coming out of the market. The reason it comes out of the market is when the entire volatility goes up very high, it kind of flattens out the skew a bit. When there's, because the prices get so high for the out of the monies that when the implied volatility goes up, it tends to flatten out the skew a little bit. And that's what we're seeing in the last few days here. When we've had a lot of volatility and the implied volatility has gone up, it tends to flatten out the slope.
Gotcha. So does this sort of frame your perspective on what strategies might be good in this environment? Or how do you look at this and say, well, now is a good time to be trading a bearish strategy or a neutral strategy or things like that?
Yeah, so I don't tend to get too directional just because I'm usually wrong. But I'm pretty good at trading skew type, and so I wouldn't want to be buying, for example, in a steep fall environment, you don't want to buy a put and sell a put here. So you don't want to do a short put spread, even so you could tell it's a little bit steeper on the put side, so you got to be, so there are definitely different types of trades that do better in this environment. So and you have to be pretty agile to figure it out. But what we do at ORATS is we will backtest these things and see which strategies do better in certain environments. So I think that's kind of, now that we've learned about this is an expiration IV skew. There's a term structure skew here that we also look at. This is more of a calendar. This is more of a vertical trade. But still, this is, these are two different types of skews, very, that demand different types of strategies. So since the term structure was off, you could see on the left side of this very high volatility. That's kind of the short-term backwardation that we're seeing, but a longer-term kind of contango. So this is a strange type skew. If we were to draw a line through it, it would still be in contango. So if we're drawing a rational skew through all those points, which is what we're looking at. It's called X earnings, but it's really just smoothing out the points. So we're kind of drawing it through here. So if you think, here's a 16.5 and here's a 13.5. If we were to draw that from 16.5 down to 13.5, that's how it would look. So that's what most of the points are. We kind of ignore under 15 days, just, that's a different type of trader. So on the overall term structure is still very much in contango here, meaning the front months are below the back months, even though it looks strange, past 1 week, really. Look at it. The traders are expecting this to be kind of over in a week. And then I would probably look at some of our resources in the macro calendar and see what's coming up. Friday, there's a lot. Thursday, there's a lot. There's some hourly, wages and unemployment is Friday. Thursday is jobless claims. So it's the rate cut, and there's a lot of tumult in the market. So there's a lot coming up on Thursday and Friday, Tyler.
Yeah, interesting. And if you go back to the outlook, that I saw that contango graph. We put them right next to each other. So we were just looking at a slope and the graph right next to it, right? And then now we're looking at the term structure and then the contango graph right next to it. So it's you're looking at the X and Y interpretation of it, and then you're looking at our measurement of it over time.
Yeah, that's a good point. I mean, and it's interesting to see contango now, like it was pretty high. Like usually zero contango is flat right across, right? Let's draw this smooth, but we're in quite a bit of contango right now. We're in, it's measuring out definitely above zero. The highest it gets is almost 1, and that's just that. There's a slope to contango that we also measure. And you can see that when the market crashes, then that's when backwardation comes. Backwardation is negative contango, and so that's what happens here. And then it's been coming back from that kind of, right here on October 10th when the market went down, and then it kind of continued to be volatile, and it got to negative 0.34. That was the lowest we've seen since May. This is that chart, how long the chart is. So, we're still positive contango, but it's in the direction of negative. So we'll see what the market does. But definitely in the front months, there's backwardation, but in the back months, it's in contango. So kind of a strange time right now, Tyler.
All right. Yeah. Interesting.
Yeah, but so anyway, one of the things that we're talking about here, though, is not only understanding what skew is, but understanding how to profit from it. And so one of the ways is, that we look at is, we backtest certain strategies, for certain types of markets. So, we'll look at, like the, we've broken out different symbols. Here is SMH, the semiconductor, where we only backtest in certain environments. So so how does a certain strategy do when the IV percentile, now it's high, it's interesting, implied volatility has gone up, so we do a percentile over a year, and so now it's in that kind of 66% and above, but we're talking more in the slope percentile. So we're still, and this is what we saw earlier, in the steepness. So it's moderate right now. So you could say select none, and then you could say just in moderate, or I like to let's just look at when the slope is high, what types of trades tend to do better. So, we could look at short put spreads, for example. And let's just look at something from 20 days to 60 days, and a delta that's kind of a little bit higher than way out of the money. So in this type of a situation, I would say that, well, it's kind of a two-edged sword, because when you're selling a 23 and buying a 4, the 4 is so far out of the money, there's not much premium in there. So this is the best performing one in that type of when the slope percentage is high. So let's look at when the slope percentage is low and just see if there's anything that we could learn from that. So now when the slope percentage is low, look at what happened. The volatilities really changed a lot. So, what that's saying is that, so what we're doing, generally here, is in a short put spread, you're selling the 55 delta, buying the 25 delta. So that's a serious skew with serious options. So it's a lot different. So you want to know about that, because recall that the best one was just basically a plain selling the 25 delta when the slope was high. Now this is when it's low. Now you want to do this, now you want to kind of do this relationship now. So it's interesting to see what performs and when.
So why is that? Is they're just valued slightly differently?
Well, in this case, so right now, you're selling kind of the at the money and you're buying it out of the money. And it's a low, meaning you're buying a lot of good stuff, and you're selling kind of at the money. So you're getting a lot of premium here, like that, and that you think is if it steepens out, then that's really going to do well for the 25 is going to move more versus the 55. So this kind of ideal, like when the slope is really low, it's kind of ideal for this, type of a short put spread is what this is saying.
Gotcha. Yeah, the backtest finder is such an interesting research tool, right?
Yeah.
Like you're kind of using it to discover how, it's not just to find the best backtest. You're actually learning and discovering how the market works, right? And like how options trades actually work, because there's so many and there's so many things to learn about the intricacies of the movements and everything like that.
Yeah, so you want to be careful when you're you want to be careful when you are getting into a vertical and know how the slope is, and you want to put it in your favor. So that's and then the backtest finder is kind of testing that out and saying that it doesn't happen that much. It's only 43% time, and I've set it at 40. So it would probably be, even if it's more if we give more room to it, we'll see more and more.
I wonder, do you think we could optimize these even further?
What are you talking? Oh, you're talking about using the optimizer itself?
Yeah.
Yeah. So I wouldn't use this to optimize it. What I would use to optimize is I would then. So Tyler's talking about our product that is able to use skew and slope, and I want things more in the market like I just put 88% of the time. So we could look at what this looks like. Trying to get this is
so the difference right between like the optimizer and the back tester is you can just get a little bit more granular with the indicators and when you want to get in and out, right? Like in the back tester we have 5 entry triggers, right? And we just showed the slope percentile and the IV percentile, but in the optimizer we have I think it's close to 100 indicators, and you can combine like slope and contango and that kind of stuff to, kind of once you understand like how the relationships work when using the backtest finder, you could go here and get some interesting stuff.
The problem with this is that, this is not going to optimize. So there's no movement, and then it just does something. So there's no benefit to, there's no benefit to a good indicator if there's not enough volatility in something. So,
yeah, maybe short put spread isn't the best one.
This one's a little bit better. You can see it kind of moves around a little bit. Mm-hmm. But I think we're going to see p-values not as bad, but like so what I know how this works. So yeah, the p-values are really, that's interesting. So so we're looking at how do we what's a good indicator that's gonna show when to get in and when to get out of a short put spread. Now, short put spread acts a lot like it's long delta, so it's a lot of like stock. And so we're seeing p-values. We want p-values generally in the 0.2 and below. These, like if 0.89 means it's 89% just relative to chance. So that's not what we're looking for. Contango, that's interesting that's up there. That's definitely something that we think is the one of the more important indicators for for this type of trade. But again, I would pass on this because there's not really that much to Tyler to short put spread and optimization, just because of it's moving just like the stock, and you're not going to find a lot of indicators that predict stock price movement.
Yeah, I mean, using the optimizer effectively is a skill in and of itself. right?
Well, yeah, because the optimizer is finding option-related information that can help you find timing to get into types of trades. If you're, long stock, the reason stocks go up and down is other information other than we have. But if you find a strategy that takes advantage of certain, it's a more neutral strategy and doesn't have just the long stock or a short stock, large absolute delta, then it's going to be a lot easier to optimize on it.
Yeah, that makes sense.
Yeah. So, and another thing that you want to think about is a stock scanner. Like, so in our stock scanner, if you want to find certain stocks, I have some stocks in here that if I look for that I've kind of looked at before. So here's a put call skew. Actually, I think I'm over here. If I look at, I have development, and so I look for, I have some saved strategies in here. Forecast. Put call skew. Okay, so here's a put call skew that has, minimum stock price, high confidence, volatility between that's reasonable, slope. Now slope percentile, that's high. Slope forecast, slope to ratio. So these are slopes, that are, in at, let's see, max of 50. So underneath that. So we're looking for low skew. So silver has, and we talked about this before, silver has a low skew, slope of only 1.89. Gold as well, TLT. These are all pretty flat. Like I said before, they tend to get more volatile as they go up. So this is how that we would identify types of stocks with low slopes. If we were looking for a high slope, I clear these settings and I'd look. I always like to put in volume, so I want volume, over 7,000. Let's just say 7,000, and then I want to find. I'm not sure if it's in the ratios or not. Skew, here's skew. Slope that is high. So, and we'll sort it by the slope. So yeah, HYG is the steepest. EFA is pretty steep. Diamonds are steep. And there's a SPY. So, the SPY is at 7%. So, which is typically, quite steep for the SPY. And we could add slope here. So this is, I don't know if you recall in the outlook, we saw it get really high. That was 9%. I mean, that's as high as you see it. And then it's dropped down as the market came down to 6%, but it's still quite high. So that, that kind of says you got to be careful on what you're buying. Mm-hmm. If you're doing a short put spread right now, it's quite, and it's quite a steep skew still. And, that short put spread will, tend to fall in value.
Yeah, pretty cool to view it over the trade builder there.
I wonder if we could see like if we could put a short put spread together here and see, like in the trade history, how it performed.
That'd be cool. Yeah.
So what is this? A 668? Let's sell this one, and then buy something up here. So there's a this is a long put spread, right? So let's see how this has performed over the last couple of weeks. I mean, it's going to be affected by, it's a lot of delta, but it will tend to change. So it was worth a lot, and then it's come down, as the market's gone up, and it's gone back up as the market. So it's mostly this is mostly delta, but sometimes it's fun to you can see how a certain strategy has performed.
Well,
I should have picked something with less delta, but because this is being driven just by the stock price. But you could see if you had something a little bit more out of the money that didn't have as much delta, you could see the skew changing and how it affects the price.
It's so interesting to use this. It's like the backtest finder. It's like a research tool, right? Or you're like, I want to explore how this strategy changes over time in relation to the delta or the theta. And you can kind of explore and learn more and more. We've heard a lot of feedback from clients that, they love using ORATS just to, like, learn more about options. And I think it's truer than ever. Like, we have all these indicators. Not only can they help you discover trade ideas, which we'll talk about on the summit tomorrow, but they can help you learn about how options work and what different strategies mean and how they interact with the market.
Yeah. So just to, wrap it up here, we talked about the two different types of skew. When people talk about skew, there's a term structure skew. Now in the first week, we're in backwardation. In the back months, we're in contango. So that's kind of an interesting looking skew right now, a term structure skew. And then there's the expiration skew. And where it's pretty steep still, it wasn't as steep as it was a little bit earlier last week before the market kind of went down. So it's still pretty steep. So, you have to be careful when you're trading verticals, especially in an expiration skew like this. And contango is when you sell the front, contango with a calendar, I wouldn't want to be doing a contango trade yet because you're selling here and buying here, unless you're doing it short term, but then, you have other issues. So it's not like you should do it. People are saying, oh, vol's high. No, like right now, the back months are really high compared to the front. So sure seems to me like this contango, if the volatility stays here, this contango might come out of the market too.
All right. Well, yeah, we're just about out of time, Matt. But it was a great show. I learned a lot, and it's just such a great platform for learning about the volatility surface and all these other indicators and tools. So many data points. It's great to see. Thanks for showing it.
Yeah, and you could dive deeper. So you learn about it, but then you say, well, what about backtesting about it? What about examining a trade over when we've seen things? So you could dive much deeper. Even when you find out and learn about it, you could see when's the best time to use it in a backtest. So that's why it's extremely powerful.
Very cool. All right. So that wraps up for today. But we are going to be back on Tradier tomorrow. I think it's noon Eastern or 12:15 Eastern.
Yeah, you could catch Tyler and me on the summit from Tradier, so that'll be fun.
Yeah, we're going to be talking about trade ideas. So we'll be going over that. Thank you, Tradier, for hosting us this week. If you guys have any questions, feel free to email us at support@orats.com or leave a comment in the YouTube, post on our community channel, and we will see you guys again tomorrow. Thanks, Matt.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.